Hello and welcome. Coming up in today's stock analysis video, we are going to examine Nike, or depending where you're from, Nike. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarise our findings. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. Before we jump into the key pillars, let's find out what the latest news headlines are for the company. Nike sells athletic footwear, apparel, equipment and other accessories and services worldwide. The company owned the trademarks for Jumpman, Converse, Chuck Taylor, All Star, One Star, Star Chevron and Jack Purcell. Nike CFO Matthew Friend told investors that the company was cutting back on orders of the classic shoes such as Air Force One, as well as current Pegasus running shoes, as Nike shifts its focus to developing new products. Levi and Korsinski notifies investors that it's commenced an investigation of Nike concerning possible violations of federal security laws. And finally, Prime Minister Rishi Sunak said Nike was wrong to mess with the design of the flag on the England team's football shirt, as the debacle entered the political arena. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. For Nike, this is 7%. As the stock market tends to favour growth companies, I want this number to be greater than 10%. Now let's look at the free cash flow, which is the money a business can generate from its operations. And here we can see that Nike have increased their free cash flow by 33% over the last year. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Nike has only managed to increase this over the last year by 3%. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. So for the last 12 months, Nike's book value has grown just by 4%. Again, ideally we want the key pillars to grow by 10% each year. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital is 20% and return on equity is 37%, which suggests that Nike's management is working very effectively. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. And in Nike's case, this is excellent as it's 1.93. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is 44%, and looking back over the last 10 years, this is a little lower than in previous years. Next we come to the operating profit margin. This tells us how much profit a company makes on a dollar of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Nike's operating profit margin is 12%, which is a little under the ideal 15%. Now we're going to look at the free cash flow yield, which is a financial ratio that compares the free cash flow per share of a company against its market value per share. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability than traditional earnings or dividend yields. It's based on the actual cash a business generates rather than reported earnings, which may be subject to various accounting adjustments. He typically looks for a company that has a free cash flow yield of 5% or higher. So at 4.37%, this is very close to our ideal yield. After that, we come to the PE ratio, which Peter Lynch believes is a key indicator when evaluating if a company is under or overvalued. This is 27, and it's a little higher than I would like, as I prefer companies that have a PE ratio between 5 and 20. So we'll need to decide whether or not this company represents good value. And lastly, we come to the enterprise value divided by earnings before interest and taxes. Like Peter Lynch, Joel Greenblatt uses this metric to identify if a company represents value for money. And like the PE ratio, we would like to see this under 20. We'll come back to Peter Lynch and Joel Greenblatt's valuations later on. Having looked at all the key pillars, let's now give Nike an overall score. I've given free cash flow, return on invested capital, return on equity and gross margin full points, but the rest of the pillars only half a point each, which gives Nike a score of 7.5 out of 11. If you're interested in reading the annual report, I've included a link in the description below. Nike has a large market cap and Morningstar believe that they have a wide moat because they own about 32% of the market share for apparel and footwear. Now let's look at the ownership. There are currently 5 super investors who own this company. If we look back at Mario Gabelli's previous sales and purchases, we can see he has repeatedly bought and sold Nike shares and has recently bought 127,000 shares in the last quarter. However, 9 other super investors have sold their shares in Nike. Terry Smith has owned Nike for a number of years, but over the last year, he has reduced his stake in the company to about 3.6%. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. As we can see, the share price was happily going up year on year from 2017. However, Nike seems to have peaked during 2021 and seems to be dropping since its fall in 2022. Only time will tell if this year continues the trend of a falling share price. So let's see what the analysts think. A number of analysts believe that Nike is undervalued at the moment. The general consensus is that Nike is still a buy based on the company's financial health, dividend and present share value. The average price target by the analysts is $116. Now, in order to build a valuation, we need to look back at the past, but also decide on a possible future for the company. Let's look back for the trailing 12 months and see what insight this gives us. The PE ratio is 27.21, earnings per share is 3.46, which gives us 7% growth. Free cash flow per share is 4.11, which gives us 33% growth. Revenue is 33.64, which gives us 3% growth. Book value per share is 9.23, which gives us 4% growth. The equity growth over the 10-year average is about 5%. Let's add some context to the revenue by looking back over the last 10 years. The year-on-year improvement is really impressive, and Nike has consistently made revenue gains for the last decade. If we look at the revenue and expenses chart, we can see that 56% of the revenue brought in goes on its cost of sales, and a whopping 77% of the gross profit goes on expenses, which is definitely affecting Nike's gross margin and operating profit margins. Here we can see that Nike's earnings per share have always been consistently over $3 for the last 4 years, and we can see a slight gain this year. Next, we need to decide which type of valuation will be best suited for this company. A discounted free cash flow to the firm, a dividend discount model, or an earnings per share growth model. For this particular company, I'm going to use an earnings per share growth model. Now we've looked into the past, let's project into the future. So I will use an EPS of 3.46 as my starting point when creating a valuation. I'm then going to use a 10-year average equity growth percentage when projecting the company's future growth, which is 5%. I'm then going to give Nike a PE of 25. After that, I'm going to project these numbers forward by 10 years. This then gives me an estimated future stock price of $140 per share for its future share price. We then need to include a 15% return, and then we work out the current value, Phil Town calls this the sticker price, which is going to be $35. And finally, we're going to apply a margin of safety, and in this case, it's going to be a generous 50%. The current share price is about $94. None of the three models that I typically used provided me with any valuation that was any better than $35 per share. Therefore, I need to gather a little bit more information. In this next section, we're going to split the chart into different zones. And our first zone is what we can look back at as being the market bottom for Nike, which was about $65. And in this case will represent our margin of safety. After that, we identify zone 2, which is about $83 and is slightly lower than the 52-week low of $88 from last year. We currently seem to be in zone 3, which is about $94 right now. And finally, zone 4 is what we identified as being our exit strategy, or at least the point when we take some profits off the table, which I think for Nike it has the potential to go up to $127 a share. But because this is the same as the 52-week high, I'm going to adjust it to the pandemic heights of $175. I personally don't think it will get to this high again anytime soon, but we'll use this number during the potential returns later on in the video. This chart compares the share price against the fair value of the stock, which is based on the discounted cash flow model, and it suggests that the fair value is closer to $70 a share. In this next section, I'm going to get some help from some super investors. To start off with, I will use the Peter Lynch PE ratio model to help determine if the share price is overvalued, fairly valued, or undervalued. So we take the share price, add the dividend yield, and divide it by the current PE ratio. So using this model, it suggests Nike is currently very undervalued. Then we're going to move on to Warren Buffett's 10 cap model, where you divide the free cash flow with the market cap. The higher the percentage, the more the company is undervalued. So at 4%, it suggests it is slightly underpriced. After that, we're going to move on to Joel Greenblatt's favourite tool for working out if a company is correctly valued, which is dividing the enterprise value by the earnings before interest and tax. At 23.62, this suggests the company is slightly overvalued. Finally, I've also included Phil Town's earnings per share growth model that I used earlier. This suggests we are currently significantly away from the price he would be willing to pay. If you're interested in reading any of the books by the super investors I've mentioned today, please look in the description to find out more information. In this graph, we're going to compare the operating profit margin of Nike, Skechers, Steve Madden and Adidas. By comparing the operating profit margin, we can see the relative performance between Nike and its main competitors. And this means Nike are more efficient at generating profits from its core business activities, as well as being better positioned to protect themselves during the economic downturns. In this next graph, we compare the return on invested capital, and we can see that Nike are outperforming its rivals on this front too. However, when comparing the PE ratio and then the enterprise value to EBIT, we can see that Nike is still slightly overvalued, but nowhere near as overvalued as Adidas. In this next section, we find out what our potential return would be if we bought at today's price of $94. And when the price was at $64 and at $83. If the share price was to hit the 52-week high of $128, then we would see a return of 36%. Or if it was to hit the highs during the pandemic of $175, we would see a return of 86%. Whereas if we had bought Nike at $65, you would see a return of 97% and 169%. And finally, if you bought Nike at $83, you would see a return of 54% or 111%. Nike pays a dividend of 98 cents, and this has grown by 56%. The payout is 36%, so the company are not overreaching with their dividend it pays out to its shareholders. Finally, let's summarise what we found out about the company. When reviewing the key pillars, Nike scored 7.5 out of 11, and I personally want to see a company score 8 or above, as I only want to invest in companies that are the best of the best. Under ownership, while 5 super investors have bought in the last quarter, we found out that 9 either sold out or reduced their share allocation. The past results tell us that since the pandemic, Nike's shares have trended down. The analysts are indicating Nike is a buy and are predicting they will grow on average 14% over the next 5 years. However, when looking back at the past 10 years, Nike's average growth rate has been 6%. Using the different valuation models, my personal buy price would have to be below $85. I do believe the pandemic lows and highs have given us an unprecedented indicator to the stock market, and we can use this to assist us when valuing a company's share price. My final overall rating is 3 stars out of 5, and I have given this a category C rating within my own stock watch list, with obviously A being the highest score. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating. And lastly, if you've enjoyed the video, it would be greatly appreciated if you could like and subscribe to help the channel grow.